In the year 2000, three men flew from California to Dallas to make a proposal. They walked into the boardroom on the 27th floor of the most powerful entertainment company in America, and they offered to sell their struggling startup for $50 million. The CEO of that company listened. Then he laughed them out of the room. That startup was Netflix. But here's the part of the story that almost nobody tells. Blockbuster's biggest mistake wasn't that meeting. You already know how this story ends. Blockbuster laughed at Netflix. Netflix won. Blockbuster went bankrupt in 2010. The moral everyone repeats is simple. Don't ignore disruptive technology, except that's not what actually happened. In 2004, Blockbuster CEO John Antioco saw Netflix coming, so he built a direct competitor called Blockbuster Online. He eliminated late fees, the policy customers hated the most, even though it cost the company $400 million a year in lost revenue. Within 18 months, Blockbuster Online had grown to 2 million subscribers. It was genuinely closing the gap on Netflix. Mark Randolph, Netflix's co-founder, even said publicly that Blockbuster had finally mounted, in his exact words, a truly legitimate and sustainable challenge. Netflix was worried. Then one man bought 10 million shares of Blockbuster stock. And everything that was working stopped. What I'm about to walk you through comes from three primary sources. First, John Antioco's own account, published in the Harvard Business Review in April 2011. Second, Carl Icahn's rebuttal, published in that same issue of the Harvard Business Review. And third, the documented financial record of what happened to Blockbuster's online business after the boardroom changed. Both men told their version of the same story. Together, they told the truth. Let's go back to September 2000, the day this all began. Reed Hastings, Mark Randolph, and Netflix's chief financial officer, Barry McCarthy, flew to Dallas. Netflix had 300,000 subscribers. The company was losing $57 million a year. Blockbuster had 9,000 stores, 65 million registered customers, and $6 billion in annual revenue. The proposal was simple. Netflix would become Blockbuster's online division. Blockbuster would promote Netflix inside its stores. Together they would dominate both the physical and digital rental markets. The asking price was $50 million. That was roughly what Blockbuster spent administering late fee collections in a single quarter. According to Barry McCarthy, CEO John Antioco's response was simple. They were laughed out of the office. To be fair, Antioco's reasoning made sense in 2000. Netflix was a dot-com company losing money by mailing DVDs. The dot-com bubble had just burst. Streaming video didn't exist yet. He said publicly, the dot-com hysteria is completely overblown. Netflix is a niche business. He was right that Netflix was a niche business. He was wrong about what niche businesses can become. But the decision in 2000, while expensive in hindsight, was not the decision that killed Blockbuster. The decision that killed Blockbuster happened in another boardroom, 5 years later. Every industry reaches a point where a competitor seems too small to matter. The danger isn't missing that moment. The danger is assuming that the niche will always stay niche. When Blockbuster laughed Netflix out of the room, Netflix had only 300,000 subscribers and was losing money. 4 years later, it had 2.6 million subscribers and was profitable. The distance between niche and market leader is much shorter than established companies usually assume. By 2004, John Antioco had changed his mind. Netflix now had 2.6 million subscribers. Its revenue had grown from $5 million in 1999 to more than $500 million in 2004. Antioco understood exactly what he was looking at, so he proposed a serious response. First, launch Blockbuster Online, a direct subscription competitor to Netflix, priced below Netflix. Second, eliminate late fees, the single most hated part of Blockbuster's business model. Those fees generated $800 million a year. Third, introduced Total Access, a hybrid service that allowed customers to rent online and return movies in store for free replacements. No competitor offered anything like it. The strategy was painful in the short term. Eliminating late fees cost Blockbuster $400 million every year. Building the online business cost another $200 million. But it was working. Within 18 months, Blockbuster Online reached 2 million subscribers. Netflix's own internal analysis identified Total Access as a serious threat. For the first time, Netflix was worried about losing the market it had created. John Antioco later wrote in the Harvard Business Review, "I firmly believe that if our online strategy had not been essentially abandoned, Blockbuster Online would have had 10 million subscribers and we'd be rivaling Netflix for leadership in internet movie delivery." Notice his choice of words. Essentially abandoned. He didn't abandon it. It was taken away from him. Most people think the Blockbuster story is about a company that refused to change. The real story is very different. Blockbuster did change. It built a competitor to Netflix. That competitor was working. It was closing the gap. Then people inside the company, people who had never run the online business and never would, reversed the strategy. That distinction matters. One version of the story is about vision. The other is about governance. In 2004, Carl Icahn started buying Blockbuster stock. Icahn was one of America's most feared activist investors. His strategy was straightforward. Buy a large stake in an underperforming public company. Get seats on the board. Demand cost cuts and quick profit improvements. Then sell when the stock price rises. By 2005, Icahn owned 10% of Blockbuster. That gave him 3 seats on the board. He immediately went to war with John Antioco. His argument was simple. Antioco was destroying Blockbuster's profit margins. Eliminating late fees was reckless. Spending $400 million every year on the online business was burning cash the company couldn't afford. And Antioco himself was being paid too much. Icahn wanted something very different. Cut the losses. Bring back late fees. Focus on the profitable retail stores. Return cash to shareholders. What he didn't want was to build a streaming business. He didn't see the future of streaming. He saw a spreadsheet. Over the next 2 years, Icahn gained even more influence on the board. He publicly attacked Antioco's compensation. He installed directors who agreed with his position. By 2007, the conflict reached its breaking point. Antioco was due a $7.6 million annual bonus after a successful year for the online business. Icahn refused to approve it. Antioco resigned. Icahn then installed a new CEO, James Keyes, the former head of 7-Eleven. Years later, Carl Icahn called Blockbuster the worst investment of his career. In his own Harvard Business Review essay, he wrote, "To this day, I don't know what would have happened if we had avoided the big blow-up over Antioco's bonus and he had continued growing Total Access. Things might have turned out differently." Think about that. The man who dismantled the strategy later admitted it might have worked. That single sentence explains everything. James Keyes became CEO in 2007 with one clear mission: cut costs, restore profitability, refocus on the retail stores. He reversed almost everything Antioco had built. Late fees returned. Investment in the online platform was dramatically reduced. Total Access, the product that had Netflix worried, was pushed aside and eventually shut down. In 2008, a reporter asked Keyes directly whether Netflix and Redbox were serious competitors. His response was, "Neither Redbox nor Netflix are even on the radar screen in terms of competition." 2 years later, Blockbuster filed for bankruptcy with $900 million in debt. Between 2007 and 2010, Netflix grew from 7 million subscribers to 20 million. Meanwhile, Blockbuster's subscriber base collapsed. Total Access disappeared. Late fees returned. Customers who had come back because of the hybrid model and the elimination of late fees left once again. This time, they left for Netflix, and they never came back. In September 2010, Blockbuster filed for Chapter 11 bankruptcy. The following year, Dish Network bought what remained of the company for $320 million. At its peak, Blockbuster had been worth $5 billion. Carl Icahn owned nearly 10% of that company. In the end, he received almost nothing. James Keyes was not a bad executive. He was simply the right executive for the wrong problem. A company trying to transform itself from physical retail to digital streaming hired a leader whose expertise was running convenience stores. The board chose him not because he understood the future of entertainment, but because he knew how to reduce costs quickly. When companies appoint leaders to manage a crisis instead of leading a transformation, they usually fail at both. Now here's the number that puts everything into perspective. In 2000, Blockbuster could have bought Netflix for $50 million. As of 2024, Netflix is worth more than $300 billion. But here's the more important number. By 2005, Blockbuster Online had 2 million subscribers. It was growing. Carl Icahn's intervention eliminated roughly $400 million a year in online investment. That was the investment John Antioco had been making. Over the 3 years between Icahn joining the board and Blockbuster's bankruptcy, that adds up to approximately $1.2 billion in digital investment that never happened. That $1.2 billion is not what Blockbuster lost. It's what Blockbuster chose not to build. The platform that might have challenged Netflix, the subscriber base that was already growing, the strategy that its own CEO believed would have succeeded. All of it ended around a boardroom table in Dallas. Let's return to where we started. In September, 2003 men flew to Dallas and offered to sell Netflix for $50 million. They were laughed out of the room. That's the version of the story everyone already knows. The version most people don't know is this. Blockbuster eventually recognized the threat. It built a serious response. It was genuinely closing the gap. Then an activist investor who never attended a single meeting at Blockbuster headquarters dismantled the strategy from inside the boardroom. Netflix didn't defeat Blockbuster. Blockbuster's own board handed Netflix the market. Carl Icahn later called Blockbuster the worst investment of his career. He made that investment to protect short-term profit margins. He protected the margins. He lost the company. Next week, we'll go inside the deal that destroyed $165 billion in a single afternoon, the AOL and Time Warner merger. The most expensive handshake in corporate history. Subscribe. The next meeting is even more expensive.